All right, so let's continue on with contrary opinion rules. Let's look at investment advisory opinions. Bearish attitudes among of a large proportion of advisory services like brokerage firms and newsletters. These are people that put out investment newsletters. People pay for them to get stock ideas. Is a bullish signal and vice versa. When brokerage firms are bullish, then it's time to be bearish. When brokerage firms are bearish, it's time to be bullish. Okay? The Chicago Board of Options Exchange put to call ratio. We've looked at options. We know what they are. So when the ratio of puts to calls is high, okay? When the put to call ratio is high, that means most investors are bearish. They're buying more puts than calls. Calls means you're bullish, and they're buying puts. This is a bullish signal. If most people are buying puts, it's time to be bullish instead of bearish, okay? And vice versa. When most people are buying calls, it's time to be bearish, okay? Here's another group of contrary opinion ideas. Follow the smart money, or really not contrary opinion, but sentiment. A sentiment. What are people doing? Follow the smart money. Technicians believe there are only two types of smart investors. Investors that get it right more often than they get it wrong. Insiders, these are people at companies that have access to information the public doesn't know about. And specialists. And once again, specialists have access to supply of securities and demand for securities that the public doesn't have. Okay? Information about what these two groups are doing is available. You can find it. The rule is to do what the smart guys are doing. Okay? The problem with this is that while this information is available, it's not available for 30 days. There is a window of 30 days, a waiting period, if you will, between the time that these smart money investors take actions and when these actions are published for the public to see. And that's what makes it really difficult. By the time you get to their actions, the prices have already moved. All right, let's look at breadth of the market. Breadth of the market measures the number of issues that have advanced, gone up, and declined, gone down each day. Okay? Because of the price-weighted or value-weighted calculations used for market indexes, the indexes can be moving in one direction, but the majority of stocks can be moving in the opposite direction. Remember that the weighted, either price-weighted or value-weighted indexes are influenced disproportionately by the stocks that have the higher weightings. And so these few stocks can move the index in one direction while the majority of stocks is going in the other direction. And that's a head fake. It's a false move. Okay? If such a divergence exists, which means that the majority of stocks is moving one way, but a smaller group of stocks is overly influencing the market moving another way, okay, look for the index to change direction in the near term. So if a small number of stocks is moving up, but a large number of stocks is moving down, the index is fixing to go down, or vice versa, okay? All right, for example, near market peaks, an index like the Dow Jones Industrial Average, which is 30 stocks, will be rising. But most of the stocks on a broader index, like the New York Stock Exchange, will be declining. Okay? The reverse will be occurring near a bottom in the market. Okay? The advanced decline ratio is reported by several news sources. You can get it, and we're getting ready to look at a chart. All right, the charts below show a bullish divergence. Okay? This means that the index is going down, but the majority of stocks has started to go up. Okay? All right, so the top line here is the advanced decline line for the New York Stock Exchange, and the New York Stock Exchange index is down below. So this is the index itself, and this is the advanced decline line for the index. Okay? So the index is hitting a new low here. It's heading down. And at the same time, the advanced decline line starts to move up. Okay? We've got a higher low. It goes down, but not as low as before, and now it is moving up. So while the index is moving down, the advanced decline line has stabilized and is starting to move up. Do you believe that the index is going down, or do you believe that the advanced decline line is showing that the index will turn around? And what happens, in fact, the composite, the index, does turn around. Okay, so that shows a divergence. All right, moving averages, otherwise called MAs, moving averages. There are moving averages for several time periods, but the 200-day moving average is the most commonly used moving average. Okay? Moving averages are computed for indexes and for individual securities. So what you do with a moving average, let's say it's 200-day, you compute the average stock price for the previous 200 days. Then every day you drop the first day and add the new price for the last day. That's a moving average. Okay? If the overall price trend for a stock is down, see the blue line in the chart below, which should be coming up. Oh, it's not going to come up yet. The current price of an index or a stock will be below its 200-day moving average. So here we go. All right. So this is the chart of the spot price every day. And this is the chart of the 200-day moving average. And so when the trend is down, the 200-day moving average, the stock price trend, will drop below the 200-day moving average if the trend is down. And vice versa. If the trend is up, then the stock price trend will break above the 200-day moving average. Okay? So once again, the green line is the average, and the blue line is the spot price. Okay? All right, if the current price breaks up through the 200-day moving average on heavy volume, moves above the 200-day average, then here's the oval. So right here, the price has broken up. This is the stock price. This is the 200-day moving average. And here the stock price has broken up above the 200-day moving average. It's broken up above, okay? Then that is considered to be a bullish trend reversal. In other words, the move up is not enough. It's got to break up above the 200-day moving average. According to this technical trading rule, you would wait for the stock to break above the 200-day moving average, and that is when you would buy it. Okay? And as you might imagine, we're going to see on the next slide, when do you sell it? Not up here, not here, but once it breaks down below, that's when you sell it. And you avoid all of this, according to technicians. If the overall price trend has been up, the current price will lie above the 200-day moving average. So see the black line there on the chart? So it's moving up, it's above the 200-day. Where would you sell it? You would sell it here. It breaks down. Where do you buy it? Right here. Where do you sell it? Here. Where do you buy it? Here. Where do you sell it? Here. Where do you buy it? Here. So there's a bunch of trading going on. That's what technicians do. They trade. Okay? If the price breaks down on heavy trading volume, see the pink oval there? So right here, this is where you sell it. Okay? You sell it because that's considered to be a bearish trend reversal. So you don't sell it here, you sell it here. And you don't sell it here, and you don't sell it here or here. You don't sell it here or here, you sell it when it breaks down here. And you don't buy it back. You don't buy it back here or here or here, not until it breaks up through the 200-day moving average. Okay? All right, so we're going to stop there, and we'll move on to the next set of trading rules. Shalom.